Welcome, everybody. This is Axel Merk, President and Chief Investment Officer of Merk Investments, with this month's update to our equity market chart book. These charts are prepared by Nick. You can download the PDF at merkinvestments.com/research. Nick's commentary is here in blue below. I give you my in-between the line reading. And obviously, with the recent run-up we had after the December decline, it's worthwhile to have another cross-check of where we are with regard to equities. This valuation indicator, what it really is, it's a look at how much, if you take in the U.S. markets, total equities, what their valuation is as a percentage of equities and debt. And the construction of this you can look up if you look up the Z1 report of the Federal Reserve and other things. But that's kind of the simple way to think about it. And if you go back to 10 years ago, obviously valuations were depressed in the aftermath of the financial crisis, and equities as a percentage of debt plus equity outstanding was low. And from 10 years ago to today, the S&P had an annualized return of over 10%. Now that equities have a fairly high percentage in a historic context, we don't know what the future returns will be of the S&P 500, but if this autocorrelation is any indication, then it might be in the low single digits. Now, this doesn't include dividends, and of course, this doesn't mean it's going to be a flat line, but this is just one of the many reference points one can look at. Looking at earnings, as most have heard, is that there's been significant headwinds here, partially because the year-over-year comparisons are very tough. There was a significant earnings boost because of the tax changes, and I actually happen to also be conscious of the headwinds caused by rising wage pressures. Also, the international headwinds may be most noted in the S&P 500 here that are operating internationally mostly. As you may be aware, that a lot of the headwinds that the Federal Reserve is concerned about are really international headwinds. There are some domestic ones and some trade-related ones, and that tends to affect the S&P 500 more. Of course, you wouldn't know that if you just look at recent performance in the stock market. Business cycle backdrop. The conference board has an index that's kind of been flattening off here a little bit. The one item, and I just alluded to it, that is of concern is the global backdrop. Purchasing manager indices around the world. Some of the major economies have turned below 50. 50 is supposed to be this magic line between expansion and recession. Of course, it doesn't mean you have a recession right away, but it is these, as you can see here, the Japanese line, the German line, and the Chinese line, each below 50, declining. Now, the US PMI is above 50, but there's also been a decline. Some cynics have said, well, maybe the president wants to have a decline now so we can have a boost for the next election. Whichever it is, this is a global backdrop. Now, mind you, we should care about the US markets, and the Federal Reserve in particular should worry about US markets, but the context is that around the globe, there's been some slowdowns. The way that Draghi at the European Central Bank has phrased it is that there are lots and lots of uncertainties out there. If you take any one of them individually, there is likely to be a positive outcome. Those are somewhat his words. But what has happened is they have impacted confidence, and because they have been so prolonged. And that's really what's weighing here on confidence. Now, you could argue the other side of it is saying that, hey, lots of steps are being undertaken to stimulate things around the world. Question is whether it's going to be enough and so forth. But this is the backdrop. Financial conditions. There are lots of ways in looking at financial conditions. We happen to like this Chicago index. And the reason we like this index more than many other indices, Bloomberg has an index, for example, that we don't like so much. The problem with Bloomberg and many of these other indices is that they take the VIX index, the volatility index of the S&P 500, as to be very important. And financial conditions, as far as we are concerned, and is really how will policymakers, notably the Fed, react? And it's more about availability of credit. And if you take this index here, what is noteworthy is that we've really have at the loosest level of the cycle. And if you think about it, that means that these Fed rate hikes we've had have not really had an impact. The whole point of hiking rates, and I apologize for repeating myself for those who've had me say this before, is to tighten financial conditions. And Powell talks about how we're at the lower end of the neutral range. Well, yeah, but we're not at neutral. We're at easy. Money is easy. And by all means, there is some stress in certain areas, but where it matters, according to this index, financial conditions are very, very easy. And that may well be a contributing factor to the performance we've had in the markets. And I wonder how much longer the Fed can sustain the super easy policy. Now, obviously, they have said they'll be on pause, but I wouldn't be surprised if that pause is not going to last forever. Market breadth looks just fine. The gray line here is the cumulative advanced decline line, taking the advancing stocks and declining stocks in the S&P 500, and so that looks reasonably healthy. Then the American Association of Individual Investors comes out with a weekly survey. That one is somewhat neutral. No euphoria, no panic here. Margin debt, there are different ways of looking at margin debt. With rising markets, total margin goes up as well, but as a percentage of the S&P, it hasn't gone up. There are some folks who say we have to look at the total, but even there, if you look at previous periods of where there have been excesses, this period looks not like people are piling in head over heels in the markets. In fact, a lot of people have missed out on the recent rally. When we listen to the large banks that talk about institutional flows, they also confirm that not everybody has been participating in this rally. Then our correlation and volatility framework, please download the PDF if you want to read this framework in detail. But this chart here, the previous one was the introduction, talks about it. What you want to see is you want to see a panic where volatility is high and correlation is high, so to speak, to say that, okay, that means we have reached a quote-unquote a bottom. When volatility is low and correlation is well spread, then you are kind of in a calm, serene environment. And the way we look at this is from a contrarian point of view. And so we've come with the little shockwave we had late last year. We've come off these complacent levels a little bit. So again, this is one cross-check to look at. People talk about climbing the wall of worries here. So this is another way you can look at the markets. The VIX curve, we learned about that when we had the blow up of the quote-unquote short vol trade, where people were betting on volatility coming down. But without explaining this chart in too much detail, we are in a quote-unquote reasonably normal environment, although there are indications that some people might again quote-unquote abuse the strategy and betting on volatility go lower. If you bet on that, by the way, you can harvest some income, but it comes at very significant, I would even say severe risks. And so when too many people pile into that, you can have some dislocations. We don't have much on the technicals here. We do have a premium chart book that goes a little bit more in the technicals. But what this chart basically looks at is the 50-day moving average versus the 200-day moving average. And we're still below the 50-day moving average. Crossing back above the 200-day moving average would confirm that the market's on an upward trend. But the market did obviously breach back above the 200-day moving average. So from that point of view, it's things are reasonably okay. This is just a reminder that the yearly returns are all over the place in the S&P 500. And so when you hear that beautiful one-year outlook at the beginning of the year, the end of the year usually looks rather different. Here the summary based on the different charts that we have shown, and based on these charts, the short-term outlook is neutral to positive with longer-term signs of caution. So all of that, of course, is not too surprising with the late stages in the economic cycle that we're in. And here you see Nick's write-up on this. The question to me is always, well, what does it mean in the context of my portfolio? And obviously, we can't speak for everybody. If you do want to talk in the context of your portfolio, you can reach out to us. But more importantly, to the extent that one is concerned that one reaches the late phases in the cycle, the question is always, well, am I going to trade it? And if so, what am I going to do, right? Am I going to out of equities completely into cash? Am I going to hedge myself? Am I going to look for some way of quote unquote being diversified with an uncorrelated return? The short of it is that as uncertainties increase, as risks increase, I think it is not about pinpointing the top in the market, but positioning oneself increasingly so that one is prepared for more adverse scenarios. And I say that in context also, if you look at our business cycle report, historically the S&P 500 has done better during expansions than during recessions. And so if it is about squeezing out the last bit, well, then of course, yeah, try to pinpoint the top of the market. If it is about saying, oh, the cycle is still reasonably healthy, even if it's an advanced stage, then sure. Hey, if you want to take the added volatility that might come with it, that's fine. Ultimately, I think a lot of people, even if they don't express it that way, have a certain risk profile. And the mistake many people make is that they say, hey, I'm exposed 60% to equities, 40% to fixed income. Let's take that as a simplified model. Well, what they're really saying is they have a certain risk profile. And as this market is maturing, volatility is increasing. And so at that stage, the uneasiness with investors, in their tummy at least, I can take that sophisticated jargon, is increasing. And so to me, it is much more, well, what about managing it according to one's risk profile? And when the risk get elevated, that appears to suggest that maybe one should trim down a little bit. Now, of course, one can throw this all out and just say, hey, I have a static allocation forever, and I write it in and out. Now, there are many, many different ways of going about it. Anyway, thanks for listening. Please spread the news that we have these reports. If you think that they're of value, give us some feedback, and I'll meet you next time at the same place. Thanks then. Bye-bye.